Hello everyone, I am Dr. Swati Gupta. Today I am going to explain PE ratio, price to earning ratio. It is one of the most widely used metrics in stock market analysis. It helps to understand how much investors are willing to pay for each unit of earning generated by a company. It helps to determine if a stock is undervalued, overvalued, or a fairly valued. The P ratio measures a company's stock price relative to its earnings. It reflects the market's expectation for a company's growth and profitability. In simple terms, P ratio tells us how many rupees investors are paying for each rupee one of a company's earnings. Formula for P ratio: P ratio is equal to market price per share divided by earning per share. Market price per share means the current trading price of one share. Earning per share means the company's profit divided by the total number of outstanding shares. I have already explained EPS in previous videos. Now, types of PE ratio. There are two main types of PE ratio depending on the time frame of earnings. First, trailing PE ratio. It uses earnings from the past 12 months. It is based on historical data. Trailing PE ratio gives a quick view of how the company performed recently. Second, forward PE ratio, it uses projected earnings for the next 12 months. Forward PE ratio reflects market expectations for future earning growth. We will try to understand PE ratio through an example. Suppose there is a company ABC Limited. Current market price of its stock is rupee 50 and EPS is rupee 5. P ratio is equal to current market price divided by EPS. So 50 divided by 5 is equal to 10. P ratio is equal to rupee 10. It means investors are willing to pay rupee 10 for each rupee one of the company's earnings. High P ratio indicates that investors are having high expectations for the future earnings growth. A high P ratio may also indicate that the stock is overvalued if growth expectations are not met. Low P ratio indicates that the stock may be undervalued or it has low growth prospects. Negative P ratio occurs when company reports losses. Company reports negative earnings. For example, a startup in its early stages may have a negative P ratio because it's investing heavily in growth and has no profit yet. Now, benefits of the P ratio. The price to earning ratio is a widely used metric in stock market analysis due to its simplicity. First, simplifies valuation. The P ratio gives a quick and easy way to determine a stock's valuation relative to its earnings. Investors can easily see how much they are paying for each unit of a company's earnings. Second, comparison tool. The P ratio allows investors to compare the valuation of a company to its peers or its industry. Investors can determine if a stock is undervalued or overvalued by benchmarking a company's P ratio against the average P ratio of the industry or its competitor. For example, if the average P ratio of the technology sector is 15 and a company ABC Limited in this sector has a P ratio of 12, so we can judge that ABC company might be undervalued relative to its peers. Third, growth expectations. A high P ratio reflects market optimistic view about a company's future earnings growth. Investors can use the P ratio to judge the market's confidence in the company's ability to generate higher profits in the future. Generally, companies in high growth industries such as technology or biotech have higher P ratios as investors expect healthy earnings growth. For example, a tech company's P ratio is 40, which may seem expensive compared to the industry average. But this higher ratio could be justified if the company is expected to grow its earnings by 30 to 40% annually. Fourth, historical analysis. Comparing a company's current P ratio to its historical P ratio helps investors identify whether a stock is overvalued or undervalued. If a stock is trading above its historical P ratio, it might indicate that a stock is overvalued. Conversely, if a stock is trading below its historical P ratio, it might be undervalued and gives a signal of potential buying opportunity. Fifth, forward looking. The forward P ratio, which uses projected earnings, gives an idea of expected future performance. It allows investors to make decisions based on anticipated earnings and indicates the company's growth potentials. Now come to the limitations of the P ratio. First, earnings manipulation. The P ratio depends on earning per share, which can be manipulated through accounting or financial strategy. When EPS is artificially inflated, the P ratio may appear lower and it misleads investors and they might think that the stock is undervalued. Second, not useful for negative earnings. If a company has negative earnings, the P ratio is meaningless because if we divide the market price by negative EPS, it results in a negative or undefined P ratio and it doesn't provide any useful insights. For example, a startup company invests huge in growth and incur a net loss, which results in negative EPS. In this situation, the P ratio cannot be calculated and making it unfit to evaluate the company's value. Third, industry variation. The average P ratio can vary across industries due to differences in growth rates, risk levels, and capital requirements. If we compare companies across industries using the P ratio, it can mislead conclusions because high growth sectors like technology or biotech generally have higher P ratio due to its higher growth expectations. On the other side, stable low growth sectors like utilities or manufacturing typically have lower P ratios. A tech company with a P ratio of 30 might be fairly valued, while a utility company with the same P ratio could be overvalued. So, comparing a tech company with a high P ratio to a utility company with a low P ratio is not meaningful as the valuation norms are different by industry. Fourth, ignores growth. A low P ratio might not indicate undervaluation if a company has weak or declining growth prospects. The P ratio alone doesn't reveal whether earnings are expected to grow or decline. Companies with low P ratio could be value trap. It appears cheap but has a lacking growth potentials. Fifth, short term volatility, market sentiments, economic events, or temporary news can cause stock price to rise or fall sharply. This can inflate or deflate the P ratio even if the company's earnings remain stable. A temporary increase in stock price might make the P ratio high, overvalued, even if the company's long term fundamentals are strong. On the other hand, a decline in stock price can make the P ratio low, undervalued, even if the company faces significant challenges. Concluding it, we can say that P ratio is a powerful tool for evaluating stocks. It gives insight about valuation and growth expectations, but it has its limitations. Investors should consider other metrics also along with P ratio to make better investment decisions. Thank you.